We'll say good morning to everyone. Today is a Fed Day. Fed Day at 2 p.m. There'll be an announcement, and what are they going to do? What are they going to say? It's a typical Fed Day, and even if one knows, you can't say for sure. Um, what the market reaction will be. Swing machine will. Oops, I'm getting feedback. The That all said, I can promise you this: that swing machine will capture it. It may not be in those first few minutes. It might be ahead of time. Might be a little bit after. But there'll be a come the close of the day. There'll be a significant move, and swing machine will be on it, and it can't get by it. But I'm inclined to think the 5 year, 10 year, 30 year interest rates are are in a very nice spread. They're steep, they're nice. It's the front end that's too high. Um, I'm not looking at that from standpoint of the markets. I'm just looking at it in terms of the yield curve. So the the interest rate is calling for the Fed to cut, in my view, at least 50 basis points. I don't think they're going to do that. I don't think so. I think it's part for inflation fears, part Trump. Um, they're certainly not going to raise. Not that they're not going to do. And are they going to sit pat? I think the consensus is they're going to sit pat. I don't think they're going to do that. So I'm inclined to think they're going to cut, but they don't want to, probably, signal a panic in the market. If they got too much. So I'm inclined to think they cut a quarter. I don't think the market will like it, and I don't think Trump will like it either. But we'll see. Prior to 2008, we would get these hard sell-offs though on Fed days. And the Fed days weren't always, announced, and sometimes they would just meet over a weekend and just tell us what they did, what they decided. Now it's much more public. And I cannot remember the last time a market sold off on Fed Day. The banking interests will do anything and everything to protect the queen bee, which is their Fed, the academic stooges. And so no matter what they say, no matter what they do, it'll always be, oh, they struck just the right chord. Oh, they weren't too hawkish. Oh, they weren't too dovish. Oh, it was so smart. Oh, they're data dependent, and you have the Steve Weismans of the world come out, and everyone will come out and pontificate about what they meant, what they said. It's just all a bunch of bullshit. And but what we have seen is the days immediately following a Fed, the market take a dumper. Now, the markets on a daily basis are at an inflection point, but they could still go higher. They could. They absolutely could. But if they do, we will be seeing that as an opportunity to sell, not an opportunity to buy. And when we look at it, we'll just take the ES here. It's a quick moment to show you. On a daily basis, the ES were at 60. We were at 80. So it has pulled in a little bit. So could the market go to euphoria? Yeah, it could. Yeah, it could. And on some sort of a spike, if they cut 50 basis points, we're going to cut again, or they cut 100 basis, which they're not going to do. But if we were to do that, if we were to do that, we would see it as a selling opportunity. Let's just put the VIX up on a daily. What is the options market thinking? And you can see we're at 50 here, so they're pretty proportional, and it's in the middle, which means inflection point. We're either, it's 50, the delta's 50-50. We're either going up or we're going down, and it's a question of who's going to get the blame for this: the Federal Reserve, Trump, you know, probably Trump, right? I mean, at least from a media standpoint. But we're in the middle. So when you're in the middle, it's always more difficult to even with options to get it um, get the trade precisely on. What you could do is go further up, and sell some call credit spreads, or even sell some put credit spreads. Or you can just wait for it to play out and see what we want to do. Intraday is intraday. And normally, so be careful here today, normally we will just chop and flop right up until, the 2 o'clock hour. But we're going to let you watch. Be sure to visit stockmarketcaddy.com if you want to know more about us and who we are and who we are not. And we'll let you watch. We do have Q schools today, and so we're going to be pretty busy. We're reviewing our options. We are already at a higher price. We have expressed through our options a bearish tone. Not crazy, not a crazy amount, not but we think there's a greater probability that we're coming back. Good luck, everybody. Now we're going to let you watch, and I'm going to be involved in Q schools much of the morning. Historically, here on Fed Day, the markets are extremely choppy. This way, that way. It's just maybe directionless. Possible a little bit before we get some indication of how the market's going to react. A lot of times the reaction to the Fed is wrong. So, in any case, it's just another day. Susan doesn't even trade on Fed days, so don't feel compelled that you've got to get in here and you got to get it right and you got to be the first one. No, nothing's further from it. And in fact, one of the techniques that we teach is trading point and figure. And when we get a day like today, like Fed day, where the markets are violently up, violently down, point and figure can be a fantastic way to go. And Swing Machine is a trend identification system, but if there is no trend, we're going to chop and flop. And most trends, well, there's a couple of things. The market only trends 30% of the time. 70% of the time, it's chopping and flopping. And so if you know you're in that, you don't try to fight it, right? If you're watching Swing Machine with a critical eye, that's fine. You're on delay. Understand, Swing Machine is in fact hard coded. It is, but the market is not hard coded, right? So on days when it's violently one direction or the other, and if you're out there trying to, and you haven't been in service on how to trade this tool, and you're trying to, red light, green light this, you could get very frustrated and could get hurt. So I wouldn't suggest you do that. And we suggest you visit Stock Market Caddy, the website, and learn what we're about. But we will let you watch. But on days when it's violent one way or the other, when I say violent, I'm just talking about lots of market orders. Although the program is hard coded on the smaller time frames, particularly like a 1 minute or if it was a tick count, it can appear to miss a sprocket, like the sprocket on your bicycle. You get jammed, as a kid, and so we don't want to see anyone get jammed. So just know that we're going to let you watch. It'll be fun to see how the Fed is going to navigate this and the media all around it. And it's anybody's guess, what they're going to do, what the market reaction will be. I'll play the parlor game. I'm inclined to think they cut 25 basis points. I'm inclined to think that the markets will rally, and I think we'll be right back down. And if they do, I think we'll be right back down the other side come tomorrow. But we'll see. We'll see how that plays out. I don't think they're raising. I think the consensus is they're going to stand pat. I don't think they're going to do that. Trump probably wants that so then he can badger the hell out of them. But and I don't think they're cutting 50. They probably, based on where interest rates are, they probably should be cutting 50. I'm not a fan of that. I'd like to see them raise it, but they're not going to do that. No, not going to do that. Going to keep the juice, keep the market juiced. So have fun. Be careful. We're not punching up so that folks can be, trying to mimic trades. We're not. And Swing Machine can help you get in. It can also help you stay out, and which is just as valuable as getting in on a trade and staying out. So we do in service in the first few days of Q School how to go about trading Swing Machine, and it takes some instruction, some patience and discipline and some practice. And there's a number of different ways of trading it, right? There's not just one. So be careful. Good afternoon. Good afternoon, everyone. This is Bagger. Here we be. Fed Day. What are they going to do? What's the Fed going to do? What's the Fed going to say? Oh, Jesus. Oh, end the Fed. End them. Not necessary. Useless as tits on a bowl, guys. I'm sorry. I hope I didn't offend anybody. Um, just useless. We would do a lot better off without these central bankers, unelected, unaccountable, really, in the scheme of things. I don't like them. I really don't. And they're in here trying to manipulate things. But let me just go to. We're still learning this tool, by the way. I promise I'll get myself self-educated on it here in the next week or 10 days. And hopefully you're getting a really nice image. I think we are. I think we're past that a little bit. And let me go to our analytics on YouTube. So we've got to. So if you've got any questions about anything, you let us know. Let me know if you aren't getting a good image. You want to make sure you set it at 1080p. There should be a little slash 60 because we're sending it through at 60 bits. We've got it sized at 1080p. It's about the best image that we can get from YouTube, provided also you have a good internet connection. And we're uploading it right now as fast as we is allowed by our machines. We're now at we were at 1 gig up and down. We're now at 2 gigs, but my computer needs to be upgraded. Anyways, it's in an upgrade cycle, and it only accepts like 1 gig. So we got to get everything's getting faster and faster. And so when we do that, it'll probably be a better image too. Our plan is for annual members that might be listening to, we're going to be uploading for annual members a live feed into the website that'll be there hopefully all the time. Right? That's the plan. So you won't have to sign into YouTube. You won't even have to sign into Zoom. You just go. You got your membership. You can go into the website, the members website, and there'll be a view there of something. And then if we're talking or showing things, that's what we'll be where we'll be doing it. That's the plan. In any case, I hope we're going to get there. In the meantime, bear with us. And again, of course, today is a little of Fed Day. But if you've got any questions, and does everyone know what the Federal Reserve is, what the central banks are, what they do? Does everybody feel pretty good with that? If you don't, let me know. I'll assume that everyone knows what the game is. Um, long story short, the New York banks are a banking cartel. They're a banking cartel. They're a bunch of thieves, bunch of crooks. They take their money launderers, they're everything else. And the Federal Reserve, created in 1913 in secret by them, by the New York banks, was to create an entity that would protect their interests as the United States was blowing out to the west. Right? This is 1913. Everything was on the East Coast primarily. There wasn't much out in the Midwest. California wasn't California. We were going out west. And as the country was getting ready to grow, there were going to be more banks, out west in the United States. And key to any thriving economy, you do need banks, and you need a lot of them. What you really need is you need community banks, and you need a lot of them, because they can foster and make loans and foster businesses and develop a thriving economy. So you want to have a lot of banks in your economy. The New York banks really didn't want the competition. We want to be in control. So a way of getting control was the bankers, J.P. Morgan and a bunch of them. If you don't know the story, they met in secret. They pulled together a meeting. I think it was in August of 1913. They got in their private train cars. They didn't meet together. They didn't travel together. They traveled in disguise, and they went on a train ride down to Jekyll Island off of Georgia. And they met out there at the Jekyll Island Resort. And they also had some political benefactors there, the cronies. And they set out to create this titular head of a banking cartel. This is the long story short. It was important that that this entity look and sound like it came from government. It is a government creation, but it isn't really government. But it was really important that it appeared to do so. Otherwise, the people wouldn't have gone along with it, the American people. That's why it was called the Federal Reserve. But it's not federal. Not. It's a private concern. It's a private concern. And its existence is to protect them, the moneyed interest, them. It always has been. It just is. But it's a private concern. It's not federal. And they stack it. And so they have these Fed governors, different regions of the country, and they call them a Fed governor, as though they're an elected governor. They're not. They're appointed hacks. That's all. They're political hacks. They're academic hacks. Stooges. That's all. And they're basically told what to think, what to do, and whatever. And they control. Basically, they're supposedly mandated, of all things, for a stable currency. That a joke, isn't it? A joke. It's typical, typical thing. That I don't know what countries you're in, but they'll come out with something that they'll name it exactly the opposite of what it's meant to do. And then also employment, like they really give a crap about employment. What they do, they want everyone working until they drop dead. That's what they want, and they're looking, they want to be in control so they can maintain their wealth, and then make sure that none of those young upstart banks, that might grow out in California or in Florida or someplace else, don't threaten their livelihood. The New York money centered banks, the too big to fail guys, right? So and when they operate, they basically operate from a standpoint of the banking cartel. They privatize their wins, right? They privatize their profits. Of course they do, right? So they can collect their millions and millions and go buy those homes in the Hamptons and in Martha's Vineyard and Nantucket and But when they screw up because they over leverage other people's money, and they threaten to blow the whole thing up, then they get bailed out. They socialize the losses. Quite a gig, right? When that doesn't work for you or me or anyone else, but that's the way it is. And when you stop and you think about this, we were just having a conversation with Frederick a little bit. I'm just going to go back in time here a moment. Let me show you what the issue here is with interest rates. If you don't mind, I'm just gonna, because we are on Fed Day, right? And we'll be past it. And don't let it upset you. You don't have to trade on Fed Day. Susan doesn't. Um, they're here. It used to be, in the 90s, in the 80s, the Federal Reserve would just like make an announcement over a weekend. I mean, they weren't even public. No one even knew what the hell they were. You weren't even, if you even mentioned the Federal Reserve, you would think you were a conspiracy theorist, right? I mean, today it's just commonplace, right? And they have a big desk and they call in the press and they have an announce, supposedly, to create this, air of transparency. But before 2008, 2005, you even talked about them. You were a conspiracy, a tinfoil hat guy. And they would just come out, it might be a Saturday and you'd read it on Monday's paper or Sunday night, that, or Monday's morning's paper that they increase interest rates. Like, nobody had any idea who the hell they were, what they were doing, what it meant, none. And quite frankly, most American people have no idea today. They just happen to be extremely powerful in that they affect your wealth. No? I mean, employment, right? But they don't really come out and say like we're out to create employment. What they're really trying to do is what we're trying to get you to work until you're 85 or 90 until you drop. Now, I mean, I'm always going to be working because I want to and I love to, but if you've got another job that is not your shtick, working until you're 80 may not be so much fun. Let's look at the yield curve. This is 90-day treasuries, this symbol right here. This is 5-year. This is 10-year. This is 30-year. 90-day paper. This is the yield, not 42, 4.213. So if you go to a bank and you say, here's my $100,000 and I want to buy a 90-day treasury, the United States government is going to guarantee that you're going to get 4.213% on an annualized basis for that treasury. That's what that means. And you say, that ain't so good. How about I give you the $100,000 for 5 years? Because, right, if you're only going to do it only a 90-day commitment, maybe 5 years would be better. And the bank says, well, in that instance, we'll give you 3.896. You're like, what? If I give you my money and I make a 90-day commitment, you're going to give me 4.2 on an annualized basis. But if I give it to you for 5 years, you're going to give me 3.8? Yeah. I don't want to do that. No, you don't. Nope. The 10-year, 4.295 for 10 years. For 10 years. Now, and then the 30-year is 4.7. 30-year. Now, that's the yield on the treasury. Now, the banks have to mark it up because the banks, their product isn't corn, isn't lumber, it isn't cell phones, it's money. So they got to borrow and they got to add on percentages, like in the mortgage market. That's why the mortgage is, if the 30-year treasury is 4.778, then, they got to charge 7% for a 30-year mortgage. They got to tack it on. Now, what's important to understand is the 10-year number of things, but the 10-year treasury is the biggest, deepest, most liquid, most important market in the world. Sorry, but it is. Not German bonds, not UK bonds, not Chinese bonds, but this one. The US Treasury, the 10-year. It is enormous. Biggest, deepest market in the world. And they asked, remember Greenspan? He was the titular head of the Federal Reserve back during the Reagan years, back in the 90s and 80s. And he said, what is the one thing he looks at every morning? Was the yield on the 10-year treasury. Because everything is priced off of it. Everything. Everything around the world. So it's really, really important. Now, the historical yield on the 10-year treasury in the life of the United States is 4.5. 4.5. It's now 4.291. This line here in this algorithm is tracking the difference between the 10-year and the 90-day paper. And you can see they're virtually the same. Very, very flat. When the yield is higher here, then this will actually go negative. Now, what's important to understand is the 10-year number of things, but the 10-year, if it's historically 4.5, 4.2 may not seem like much. We'll round it off 4.3, but in relative terms, since '08, especially the United States public, the world investing, those yields had been artificially repressed by the Federal Reserve, the central bank, and they had been pushed down, down to like 2%. 2%. So folks got accustomed to that. They're not accustomed to these higher rates, and they're starting to hurt. And the Fed knows this, and the banks know this. Trump knows this. Everybody knows this. You now know this, right? We haven't had a recession to speak of really since '08, and even then, it was kind of short-lived. And the thought is, well, we can just, kind of financially engineer away from ever having a recession. Wow. And a recession is just a natural slowdown. So when these yields are orderly from low to high, they refer to them as being steep. You want to see, because banks borrow short term. I'll just get a marker. They borrow short term. Show you. They borrow, let me get a marker. They borrow short term and they loan out long term. So you want to see the yields kind of steep. It shows for a healthy market. But when the yields are doing something like this, they get inverted and the banks can't make any money. The banks can't make any money, they can't loan any money, and then we don't get the growth. And it's not just about the market, it's about the economy. And remember, the market is the market. The stock market is not the economy. And the economy is not the stock market. So you have to just disavow yourself of that. I know the fake media want to correlate the two. It's a waste of time. It isn't. But this Federal Reserve is a function of these interest rates. So they're fairly orderly here, but it's this one right here that he's going to try to affect today. I don't think he wants to cut. He's not going to raise rates because he would aggravate the problem, right? So he's not going to do that. If he holds the same, market's not going to like it. They're not going to like it. He really should be cutting. He really should be cutting like about 100 basis points, 150 to get it underneath this, but at least certainly under here. But he's not. But he doesn't want to do that either because the problem they have now is these lower rates have ushered in inflation, consumer inflation, wage inflation. So they got a bit of a governor on that. So I think what I'm thinking he'll do is he'll cut 25. He probably doesn't want to do it. If he doesn't do it at all, I think the market will react badly, and Trump is going to come out and blast them for being stupid and late and all this. If he cuts 25, I still think the market might bounce a little bit. If he cuts 50, the market might bounce, but I think it's still going to go down in the next couple of days, and Trump is still going to blame him. And it may be all a kabuki theater, quite frankly, because this Fed chairman only has another year left. And this may be all just kabuki theater. And that he's going to usher in the recession. Trump is going to blame him. He'll blame the Federal Reserve. And we get this recession in. And then in this time next year, and these rates here could go down, and this thing could get really negative, and things could be really nasty. And then Trump, this time next year or early December, January, he replaces the new the Federal Reserve new chairman, Kevin Warsh. And what's he going to do? What would he do? He'll cut the shit out of that short-term interest rate. And we'll have lower rates, and then he'll cut this one, and he'll push it down, and he'll steepen it, and he'll do that, and then the markets would light up, and the economy would light up because the banks will start loaning, people will start borrowing just in time to affect the midterm. No, you don't think the Federal Reserve has got this mapped out with Bessent and the politicians, do you? You bet your ass they do. You bet your ass they do. It's kabuki theater, but it's hard to know, right? And impossible to really trade unless you're on the end and if you're Chuck, whatever. I won't say anybody's name. Any of these billionaires won't, but that's where we be. And and now the other part of this, and I love showing this. And if you want the greatest story about the Federal Reserve, today might be a really great day. This might be a really good week. There's a great book called The Creature of Jekyll Island, about 800 pages. Suggest you read it, but if you don't have the time, go to YouTube. There are 12 one-hour videos, Cliff Note videos by the author. Get a cup of coffee, watch and listen to those, and then get back to me. And we're happy to chat about it. It's all true. And it will change your worldview. I first saw them in the late 90s. I don't think it was YouTube, but I read the book and I'm like, oh, fuck. I felt so stupid. How could I be so stupid? I had a college degree and all the thing, and it's absolutely maddening when you find out. And it really was the one book that totally changed my worldview on things and then set the stage for what Susan and I were going to be doing in the early 2000s. So if you haven't read the book, read the book. And then there's another YouTube video that you want to see is another book, a really good story about Japan and this whole money print that they did in the 90s, and it's called The Princes of the Yen. The Princes of the Yen. And you want to go see that. And couple of other great books, but those are the first two: The Creature of Jekyll Island, Princes of the Yen, and then you want to read David Stockman's book, The Great Defamation. Big book, but a good book. And then there's another one I think her name is Shales, called The Forgotten Man, and you want to read those. If you're around it, right? It's got nothing to do with making money day in and day out, but it's got everything to do with how the world works and how these markets work. And why not? Well, you're here, right? You might as well, because it is. And they don't teach you this shit in these Ivy League, madrasas of the left. When you go and get your degrees and whatever they are, they don't teach you it. They don't, because they're Marxists and they don't get it themselves. And they kind of get it, but they're into the money print. So what I want to show you though is this. And I love showing this if you've seen it at the risk of repeating it. But this is the way I want you to think about it today. So I'm going to go to a blank page. And I want to, it's 1981. So many of you weren't even born. And it's 1981. And the 10-year Treasury, how do I want to do this? I'm gonna do it up higher. I gotta think about this room I need here, because I'm gonna need room to do this. The 10-year Treasury is yielding. Guess what it's yielding? Anybody know? It was more than 16%. Imagine that. So if you bought a 10-year Treasury, if you had any money, they would have given you 16%. So if you went to a bank and you wanted to get a loan to go buy a house, interest rates were like 19, 20%. What? And in fact, when Susan and I, like the mid 80s, we got our first mortgage, and it sounded like, when I was playing football without a helmet, that one of those stories. But in terms of interest rates, it was 14 and three quarters, and we were thrilled. 14 and three. We got a mortgage, kids, for 14 and three quarters. Wow. Wasn't 16%, right? Now, of course, the houses weren't that much because the interest rates were so damn high, you know. But that's where they were, right? And there were some things going on. Now, so I'm going to kind of draw for you the bond market. And at that time, the bond market would have looked like something like this, right? Now, we go from 1981, we got the crash of 87, we got a crash in 94, we had the Thai baht crisis, we had 2008, and then we even had COVID, right? Again, but interest rates went from 16, 10-year, all the way down. Let's get an arrow. They went all the way down to about 2%, right? Maybe even less. Maybe about one. I may be overstating. About 2%. 2%. Now, think about this. Think about this, that you've lived your whole life trying to save money, dollars, right? And you're retired, and you saved yourself $1 million in 1981. You had $1 million in your retirement account, and you wanted to go live in Vero Beach, retire, and you go to the bank and you say, hey, give me one of those yields. I'm going to give you $1 million, and you're going to pay me 16% on my $1 million, and you're going to get $160,000 a year in income. That's pretty cool. That would work, right? Now it's 2020 or 2008. 2008. Same guy retires. He got $1 million. He goes to Vero Beach, and he says, "Hey, I want one of them 10-year treasuries, one of them certificates of deposit, right? I don't want any risk." And the bank will say, "Oh, sure, I'll do that. I'll give you 2%. What? I'm going to give you $1 million, and you're going to give me 2% of that a year? $20,000? How the hell can I live on that?" You can't. Oh, what do I do? Oh, I think you better put your money in the stock market. They're all retired. They're all sitting around by the pool. I'm buying this stock and that stock, right? So as rates go down, treasuries go up in value, right? And what happens to the market? If this is the bond market, what happens to the bond market? It gets huge. It ain't that. It's this. I can't even make it. It's enormous. All around the world. It gets huge. What is this? It's debt. It's big. It's enormous. And it's debt. And it's all kinds of debt. It's government debt. It's personal debt. It's country debt. And everyone's doing it. Everyone's doing it. I was talking to Frederick this morning. Sweden's doing it. Everybody's doing it. Canada's doing it. China's doing it. It's debt. It is, but we're really doing it. It's enormous. Now, by the way, a 2% return on your savings is no good if the inflation rate is 5% and 10%. I mean, you are losing ground, right? You're losing ground. So, you've got to step out, and you've got to invest, and you got to really take some risk to get some sort of return to keep up, because otherwise you work. And so then what happens is, when you don't get much of a return
on your savings, what don't you do? You don't save. You just spend. You borrow. You borrow money and you join a camping club. You borrow money and join a boating club. No, hell with that. Let's just buy a boat. Let's get another boat. Let's get another car. Let's get an Airbnb. Let's buy 5 or 6 Airbnbs. Let's buy 3 or 4 more homes. Let's get a house over here, a house over there. Let's just, I mean, because the houses keep going up. So we just keep borrowing and borrowing and borrowing. And, let's fund a war in Afghanistan. Let's fund a war in Iraq. Let's fund a war in Ukraine. Hey, let's pay for the Ukrainian Social Security. Let's just, let's immigrants can come in. We're going to give them all money. Let's just screw it. Screw it. We'll just print the shit. We'll just print the hell out of it. It can never stop. It's never ending. There's a problem though. And Wu, I want to say Wu, but it's Jay Stewart's, and he's got it. He said IOU. He nailed it. There's another bubble. What's the bubble? What's the other bubble? I'm gonna draw it. What is it? Any guesses? Wu's on it. And I'm gonna paint this one green for the moment. And it's just as big as this. See if I can do it here. Oh, I'm supposed to do it in green, make it a different color. This is the way I think about it. It's enormous. It's huge. What is this? What bubble is that? It's credit. It's credit. Somebody had to, one man's debt is another man's credit. Somebody had to loan him the money. Oh, I mean, we actually got to pay this shit back? Oh, you're supposed to. So when we gave anybody, a C student coming out of high school, in the last 20 years, could go to Harvard or go to, if they're in the right, whatever, and the government would subsidize them going to college, and they run up a $200,000 debt. And I don't know, but when I was in college, I mean, Susan and I, we didn't go on spring break. I mean, we didn't even go to the spring, the spring parties or whatever. We were too busy interviewing, too busy working. But these freshmen in college, I mean, they're not going just to Florida for spring break. I mean, they're going to, the islands. They're going on cruises. I mean, why not? It's part of the, it's part of the experience. We just, so they've run up trillions. And by the way, the earlier administration, the Biden administration, gave them a pause. They didn't have to pay any of the debt off, but Trump is making them pay. Um, Government-backed mortgages. Government-backed mortgages. We have 5 or 6 million people that haven't paid their mortgage. Even now, they got mortgages at like at 2%, and they never paid anything. And the government never defaulted on them. They just kept no, we didn't want to do that because we need them to vote for us. So we just let them, slide. Well, Trump's now telling them, well, but now you got to pay. Oh, okay, but you couldn't afford a mortgage at 2%. You still got the house. You've never paid the bank. The government's been subsidizing you, carrying your ass like everything else. But now you got to pay 7%. Oh, no, no, no. We can't do that because we got the boat club, the camping club, the cars, ba 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 ba. They got. So we better sell the house. Oh, everyone else wants to sell the house. So what happens? you know and now we're just trying to normalize. The Federal Reserve is trying to do what over the last couple of years? They're trying to normalize interest rates. They're trying to bring them back up. They're trying to bring them back up, not up to 16, but just at 4.2, 4.5. What's going to happen to the debt bubble? It's supposed to happen. This is the way it's supposed to happen. It's supposed to do something like this, right? Let's get another color. We'll make it magenta. It's supposed to contract. Let's see if I can do this. Kinda. I can't quite do it. It's probably going to wind up like something like that, but I can't. Let me see if I can do it this way. It's supposed to. Yeah, I can't. I don't know how to do that. But if I could do it, it would be just kind of like on the inside of that, right? Bring it in slowly, right? Slowly, so that these guys can get paid because they want to get paid, right? They put money at risk. So that's wherein lies the problem. And see, but we'd be like, well, just keep making the debt bigger and bigger and bigger and bigger. Well, if you keep doing that, as we saw, then eggs are going to be like, $30 a dozen. Cars are going to be 35 to 50,000. Oh no, they already are. So cars will be 100,000. They already are. So then there'll be 150,000. And then, I don't know about you. We got a neighborhood. Everyone's driving around. They're all driving around in golf carts. I was like, I can't even get a car. Right? I can't. I mean, but they were fine to buy a $50,000 car when the interest rate was at 2%. But now to buy a $50,000 car when the interest rate's at 5 or 6%, oh shit, that's like buying a car when it's 100,000. So it's all relative. So that's kind of where we be. That's a big fucking problem. So if they go back down, we do it, then we're going to have that inflation, and that's not so good. Now, in the history of the world, there's never been a slow easing of the bubble. There's never been a soft landing. They'll be talking about it today. Steve Weisman and everything. Oh, yes, we planned it perfectly. The Fed is perfect. They're under control. They know exactly what they're doing. No, they don't know anything what they're fucking doing. I'm sorry, they don't. Okay, they don't. Bessent gets it. The other guy gets it. Commerce Secretary, they get it. They know the danger in this. The danger in this is that this sucker explodes. And then what do these people do? They get really, really pissed off. They get really pissed. And they start repossessing cars, houses, anything they can get on. And guess what they also do? They don't loan anymore. They won't loan anything. They'll tighten the credit. Then it all comes in. And then at a company level, at a stock level, Warren Buffett talks about this. Then we find out what. See, when we get a huge bubble like this, stocks can be going up that don't even make any money. They're just going up. So we just buy them because they're going up, but they're not making any money. When it starts contracting, these people start saying, "Hey, wait a minute. That company we've been loaning money to. You guys actually have to make some money. You actually have to generate some cash flow." Oh, we didn't know that. And they find out, like, well, we don't even have a business model. There's the old expression, we find out who is swimming naked when the tide goes out. We're talking about that. And all of a sudden they start to, like, well, shit, we don't have a business model. Well, then you got to close your doors. And you got to lay off people. And laid off people don't buy cars, don't buy houses, and next thing you know, then the next guy, and the next guy, and the next guy. Uh-oh. Uh-oh. So the Federal Reserve could be thinking, like, you know what, this is inevitable. And if we cut the interest rates now, we haven't really done it yet. So maybe we shouldn't. Because, we know what's coming. We know what's coming. And when this bitch implodes, we're going to need some wood in the trade. We're going to need the interest rates to go from 4.2 to 3.5 to 3 to 2 to do it again so that we can reinflate the bubble. If we inflate it from now and they get a cut and we get even bigger, we don't suffer this recession that we need to suffer, then if we're ever down here at 2 and the sucker implodes, then we got nothing. Then the whole damn chalupa comes in. It's rather frightening. Kinda. Now, it's happened before. When was the last time we had a debt bubble of this size? And we make a comparison to this debt bubble bigger than our GDP. The last time we did this was from 1920 to 1929, the Roaring Twenties. They had railroads and everything was just, happy, let the good times roll, and everyone's doing great. And then what happened? What happened in 1929? Now, people will tell you that, but they did something very, very similar to what is being done right now, right? Tariff and Hartley. In 1929, they started to tax tariffs. Oh, shit. And then we had the crash. And from 1929 to 1933, now the left wing economic historians would tell you, well, that was brought on because of Tariff Hartley and all the tariffs. No, I would say to you, no, that was actually brought on from the Federal Reserve that kept things too easy, and we had a huge bubble in the 1920s. And it was going to blow, and there happened to be the tariffs. Same thing we got now. This was created by the Federal Reserve, starting really in '08. Maybe now we know why Ben Bernanke only served one term and wanted to get out. Maybe he wanted to stop it back then. And they're like, nah, we let the good times roll. Pelosi and everybody and all these people, they all made hundreds and hundreds of millions beyond your wildest ass dreams. They are so friggin' rich, and they're smart enough to know they're not holding dollars and they're not holding debt instruments. No, they're not. They're probably holding gold, real estate, So, and from 1929 to 1933, the Dow Jones, the most important index of the time, fell 90%. And then what did we have? We had a depression. A depression, not a recession, but a depression. And then what happens here is it isn't just companies taking debt. It's not just persons taking debt. It's also countries taking debt, like us, the U.S. And when this sucker begins to come in, yeah, when the bank decides to come get your hybrid car, and they know where it is too, by the way, and they can turn it off and they come get it, you're going to be pissed at the guy who repossesses it. You might even be fighting mad, God forbid. And if you're a company, you might be fighting mad, when the bank shuts you off. But countries can get fighting mad too. And it can lead to war. Yeah. This is where we're at, kids. This is where we are. And who the hell got us here? The banking cartel. Our central bank, this Federal Reserve. That's who got us here. They got us here. And they work in concert with the other central banks. Now, I'm a capitalist. It's just that we don't have capitalism. We got cronyism. We don't need them, but they need them. And you see, they can. You always wonder, how is it we can have all these wars? How is it we can send trillions to Afghanistan for 20 years? How is it we can spend? God, I lose track of all the wars we've had. I mean, how is it we can send all that money to Ukraine? How is it we can do that? Well, the reason why we can do that is because the politicians don't have to come to the American people and say, hey guys, we're going to increase your taxes from 30% to 80% so that we can pay for the Ukraine war against Putin. No, you're not. Okay. But they don't have to do that. They can just say, hey, we're going to do that. We're going to do that. And then we're going to issue bonds. And then the Federal Reserve is going to buy those bonds and basically create money out of nothing. And then we're going to send billions and trillions to Ukraine. And then, the American people will lose track of it. They'll never know. And then we're going to funnel it back through people, and they're all on it. From Hunter Biden to Graham Nisty to all of them, And but this is where we at. So when we're talking about debt, you know, it's a debt bubble. It's also a credit bubble, and there's going to be ramifications. And are we at the end point? Boy, I got to tell you, I don't know. Nobody really knows. How big can this bitch get? I mean, but we're already into the trillions mark now. Can we go another 30, 40 trillion? Maybe. I don't know. Don't know. It seems to me like we're hitting it. So, so when you hear today, you're gonna see in another hour the Federal Reserve, and you're gonna turn on CNBC, and the academic stooge, he's gonna come out, and he's gonna have a speech written for him. He's gonna, okay, well, we've been with, looking at the economy, and the economy is really good, and we're data dependent, and I think we want to just stay the course, and blah 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 blah. Just a bunch of bullshit. And then the media people say, "Oh, he walked the fine. He was dovish. No, he was hawkish. He was this. He was that. He was this. He was blah blah blah." It's just and you have to remember with all of this, right? How we define wealth, right? It isn't a number. It isn't a number. It's your ability to create cash flow from either a business, your ability to create cash flow from trading, and then your ability to hold on to that wealth, hold on to it for the long haul. You don't have to get rich. You don't want to have to get rich twice, right? You only have to get rich once, but then you have to hold on to it. If you hold on to dollars, currency, paper, you own paper. Good luck. Good luck with that. Um, Now, Bitcoin on this stuff, I don't know, kids. I don't know. I don't know. I have see, dollars are just a debt instrument. A dollar is a debt instrument. It's a debt instrument. Bitcoin and the crypto, where they've kind of lost me, is that was meant to be outside the system, outside the dollar, the monetary system. And it was supposed to be a currency and out beyond the reach of the Federal Reserve, beyond the reach of the politicians. Do you notice how that has changed? It's now no longer considered a currency, but it's an asset. And that makes my little hairs on the back of my neck stand up. Because suddenly, oh, and all the people who are in the crypto space, they want when the federal government creates a Federal Reserve Fund of, where are we now? I mean, where is that, right? It's just another asset class. And the electric better stay up, and they're probably, so I'm highly suspicious of what that is. And the thing of it is that if you want to realize your profits in that asset class, what have you got to go do? You got to go get dollars. So I don't know. I just don't get that anymore. But I'll leave that to others. But here we are on Fed Day, and um, it's not going to end today. It's not going to end tomorrow. We don't want it to end. But I can tell you when it does end, they're not going to explain it in these terms. No. They're most likely, if it ends on Trump's watch, they're going to blame him. They're going to blame the tariffs. They're going to blame anybody and everybody except themselves. And then how will they try to get out of it? They will come back and water down the currency. They always do. Depending upon just how bad things get. And then at an international level, hopefully we don't butt heads and go to war with everybody. We're at war with enough, right? But you kind of have to wonder, China also has huge debt. Huge debt. Why are they building those islands in the South Seas, right? You know, there was another Asian country after the Depression that wanted to control their own destiny, didn't have much oil reserves, didn't have much energy reserves, and didn't like us, you know, shutting them off. And that country was Japan. So this we've been here before. Are we here again? I don't know. Don't know. So in any case, happy Fed Day. Let's erase this. It's either that complicated or that simple, and I think it's quite simple. Um, and we'll just come back to where they be today. We'll go intraday, and yeah, everything's right with the world right now, right? So, and that's fine. We want the game to continue. I don't want to see the game end. Um, if I was a young person, I think I'm still young, but um, I would encourage, if I had young children, I would be teaching them, suggesting to them, is from the moment they started running around to not be thinking about a college degree. Unless they plan on being a doctor, which I'm not sure, but I would have them encouraging them to be thinking about building a business of some kind beyond just, flashing their boobies on Instagram. Building a business of some kind. And I would want them between the ages of 20 and 30 have started and failed, 5 or 6 times. They owe it to themselves. I don't think that they need to go to these madrasas of the left, these so-called universities, put themselves in debt for 250 grand, for a degree in theater or a degree in communications or journalism or God knows what. I mean, it's absurd to me. Those people don't know shit. And everything, especially with AI, there is so much that those kids could learn. Did you hear about the kid? He applied to all the Ivy League schools and they turned him all down. And he's 17 years old and he's developed a business and he's making 30 million a year. And he wrote a program that you can snap a picture of your plate of food and it'll tell you the calorie count. And it's an app. And he's making like 30 million. And the Ivy League schools wouldn't even let him in. He's not the right, he's not of the right stock. He's 17. And his mom said, she'd go into his bedroom and he was like, when he was 13, 14, and he'd be up late at night, 2, 3 o'clock in the morning, programming away. Sounded familiar. And smart kid. He doesn't need those degrees. They'd be lucky to have them. He should teach them. So, but we'll see. In another half hour, another hour. And notice too, like on the Federal Reserve, it's kind of a joke. It all started in '08, and then these people are so diminutive, right? Little Janet Yellen, she's about like 4'9", and they give her a big desk, a huge desk, and they give her all the trappings, and the people sit down below her, and it's like the Wizard of Oz, right? But which, by the way, do a Google search on this, and there's some videos out there that compare the movie The Wizard of Oz to the Federal Reserve, and that Oz is the chairman of the Federal Reserve, and the yellow brick road is gold, and the Tin Man is this and that, and it's really fascinating, and it probably is. You see, this isn't new. This may be new to you. It was new to me in the late '90s, and I'm like, how come when I went to college, university, that nobody ever talked about the Federal Reserve. That they didn't talk about it. And I had world economics and comparative this and comparative that. They didn't talk about it. They didn't talk about it. They didn't do it. I don't know if they even do it today. I don't think so because I've talked to some of the kids. They don't know. They don't know shit. No, they don't know nothing. Don't know it. They don't know. But in any case, you guys now know. So the bubble goes on, and we want it to go on, and it will go on. Not fatalistic. It's just that those that don't know the game, aren't prepared to play the game, aren't or listening to uh, you know some dude who's some boutique broker at the corner of Main and Elm, and he's telling you, you need to do this, you need to do that, and the market does this and the market does that. Okay, yeah, good luck with that. Let me know how that works out. I mean, um, I'm not telling anybody what to do with their money. I'm not. I'm not suggesting that you should or shouldn't do anything. I'm not suggesting that you should buy and hold. I'm not suggesting that you should trade. No, I'm not. I am sharing with you our view of why we do what we do, how we go about it, and then for 3+ weeks we go into even more detail. You can take it, you can chuck it, you can adopt it. We'll give you the programs, and you can, and go at it. And it's all the power, and it's great, right? This is a decentralized, and it's learn to trade your game, not anyone else's. Because in the end, I mean, I care. I want all of our I want all of our members to do well, but particularly our annual members, particularly because they have made such a commitment of time and of capital. I really want them to do well. Um, but the market is brutal in that if somebody shorted the NQ at 1240, and somebody did, trust me, right at that time, not here, and they're down $1,500, or if they did 10, they're down 15, or maybe you bought it at 1250 and you're up 1600, or you're up 16,000. The market, not me, but the market does not give a shit. It does not care. Doesn't care. No, it isn't. And the banks don't care. The companies don't care. Um, and I definitely was in corporate America in a big way. We were fortunately, and one of the companies were very responsible and very good to its employees. But we had a job to do collectively. Here, when you're trading, um, it's on you. It's like an individual. It's like playing, a professional golfer. It's on you. You got to get in, and you got to extract the cash flow, and you got to do it repeatedly, and you got to hold ground, and then probably a good idea that you redeploy these things called dollars. Maybe one day they're going to be called Bitcoin. Maybe they're going to be called Ethereum. Maybe they're going to be called dineros. I don't know. But they'll always have a currency because you got to pay taxes. They're not going to let us go through without paying the toll. So there'll always be a currency. But you need to extract from the cash flow a currency and deploy it into something that will, at minimum, hold its value and or grow over time. And then the other big piece of it is, obviously, keep your debt down. Don't let them, and even here, margin, learn to use the margin responsibly, and keep it down. I can't, it's just that simple. So I won't say anything more on Fed Day. Then we'll let it go, and they'll come and go. You'll see the headlines, and they'll be gone, and we'll be right back at it again. And they're here all the time. By the way, there is now a war room in the Treasury. There's always been one. The plunge protection team, and they're there, and it opens at 4 o'clock. So yeah, if you really want to know what time the U.S. markets really start, it's 4 a.m. That's when the hedge funds, they're in their seats and in front of their screens at 4 a.m. They're in their limos going to wherever they're going, probably some little storefront, in Stamford, Connecticut, or in Trumbull, Connecticut, in some strip mall, and they're pulling up at about 3 in the morning in front of their screens. And they don't have a lot of employees. They don't need it. They got a bank of computers, and they going to work. Or, they're down in the bowels of their yacht, parked off of Monte Carlo or off of Puerto Rico or off of Hawaii, and you know, the dumbasses are, they're trading with us. It's in their blood, kids. It's in their blood. 4 a.m. Eastern Standard Time. Yeah, yeah, definitely, Thomas. 4 a.m. is really the start. Yeah, Europe opens at about 2 or 3 o'clock in the morning, and then the war room in the U.S. Treasury opens at 4 a.m. Yep. And if they want to affect something, one way or the other, they have a direct line. Now, I'm not saying that they're in there. They don't have to be in there buying the S&P or buying the Nasdaq or gold, but they can affect it through their emissaries, right? I mean, they can call up any one of the hedge funds. We need you to do this. Any one of the central bankers, we need you to, do this or do that, to calm things down. I don't think I don't think that the central planners per se, or the politicians, are trying to get the S&P to a particular number. But what they are interested in is they're trying to keep, and I got really spooked, not spooked by this, but it just reaffirmed that Secretary of Treasury Bessent. He is a trader, right? He is a trader. Read up on him. And he was talking about the VIX. They're like, oh shit, this guy is, and so they want the volatility down, because if the markets are flying up and down and the people are all fearful, then they can't pull the bullshit that they want to pull. They can't go to this war, that war, can't do this, can't do that. So they want people just paying attention to the hockey games, the football games, camping, going on vacation, and living life. And then they get to, you know, rip everybody off. You're very welcome, Thomas. All right. But that was the cliff note. Go read the book, Creature from Jekyll Island. Go listen to who is this again name? Who is what? Mine, Creature from Jekyll Island? Or me? Who is this again? Me name. I'm Don. Oh, thank you. Yeah. Yeah, no problem. So yeah, the Creature from Jekyll Island, and you do want to read that, and understand it, and then you'll look back and, oh shit, that's what this was all about. So, all right, kids, I'm gonna shut up, let you watch, and we'll see what they do. Now, a lot of times the first move now, so we in service for 2 or 3 days how to trade swing machines, so we're not doing that here. I don't want you in there red light, green light, doing that sort of thing. That's not what we're about, especially on a day like today, because it'll be volatile. But I can tell you that after 2:15, 2:30, there'll be a move into the close. There will be. I don't know if it's going to be up or down, but Swing Machine will be on it. So we will be here. It'll be like 3:30 in the afternoon, and you'll be looking and say, "Son of a bitch." That 5 minute was at 105. It was long, and if I had gone long and stayed with it, or it could be at 220, and it could be short, and that was it, and it'll be up. It'll be up huge. They know what they're going to do. They know what they're going to say. The banks have already told them what to say and do. They're already in position. They're not getting in position now. They're already there. They can't do that with their billions. They got this mapped out. They know where it's going to be, give or take, in the months ahead. There is an old saying, win in May, sell in May, and go away. And we'll see. We'll see. But it would be unusual that the market gets dumped on a Fed day, because then it would be lead off and they would get the attention, and they don't want the attention. So they would much rather, even the banks want to protect the Federal Reserve, because that's their protectorate. That's the queen bee. They don't want to see the Federal. They don't want to hear about people wanting to do away with the Federal Reserve. Then they actually got to compete with other banks. No, and people examining what they're doing. No, they don't want that. So they want them to look omnipresent, omnipresent, omni-important. That's what they want. So if the market can rally at the end of the day, then all right, hey, the Federal Reserve struck the right code, and then they'll take them down a couple of days from now, and they'll blame Trump or somebody thinking else. That's why in 1933 they didn't blame the Federal Reserve, right? No. In 2008 they didn't blame the Federal Reserve. No. In 2020 they didn't blame the Federal Reserve. No, they blamed COVID. They blame the housing crisis. They blame, but not them. It's never them. Like everything else, don't let it bother you. Don't. We just trade, extract cash flow, and have a great life. Don't let it bother you. Well, I hope nobody finds it offensive. But one of the oldest videos I've got that we made was in 2010. So, in honor of Fed Day, if you haven't seen it, let me punch it up to you. And I'll do that right now. I'll try to. I mean, no offense. It's not politically correct these days, but it's from 2010. That was 15 years ago. 15 wasn't far off the mark. I had so much fun making that. I think I did it in about 2 hours, and it's held the test of time, hasn't it? Oh my God. Ah, I did. I had a blast making it. I remember. When I first found out, in the early 2000s, I was angry. I was pissed. You know, I didn't like it. And I found out, before the housing crisis, before the '08 crash, right? So I didn't like it. Yeah, I love the credits. I just would have had the war scenes by Lyndon Johnson. You gotta have the war scenes, right? I should have been by him. You know, but it isn't a partisan thing any longer. It shouldn't have been probably so partisan because they all do it. They all do it. They're all a bunch of crooks. So, in any case, glad you enjoyed it. I mean, no offense, but and and we talked, back then it was 2010, immigration wasn't really, we were seeing it in Florida, but it wasn't really running amok. But, we gave them everything too, right? We gave all that away, we just, just print it out. But you devalue. See, when everyone should hopefully understand this. I'll just connect the dots. Um, if you have $100,000, 100,000, and you get a 10% yield on something, right? A year, you will double your money in 7.2 years. It's the rule of 72, right? The rule of 72. So you just take the interest rate, divide it into 72, the annualized interest rate, and that'll tell you how much money or how long it's going to take for you to double your money. 100,000, annualized interest rate of 10%. It's going to take you 7.2 years to double your money. However, they don't tell you the other side of it. Let's say that you have $1,000,000. You've saved your whole life and you've accumulated $1,000,000, and you're sitting on that $1,000,000, and they start giving all the money away to everyone else, and you're like, oh, I don't care. I don't care because I got my million. Well, and the inflation rate goes to 10%. Divide 72 now. Divide by 10. 7.2. In 7.2 years, the $1,000,000 that you've saved will only buy $500,000 worth of whatever. Cut your wealth in half. Inflation is a not so hidden tax. So see, the American people don't think that it's a tax on them. Yeah, I don't care. Give the money to this guy, give the money to that guy, give it to the Ukrainians, give it to the military, give it, give it, give it. I don't care. I got mine. No, you don't. No, you don't. Because if the inflation goes to 10, you're going to have to work until you're 100. And you'll never see the light of day. They don't teach the kids this shit in college, universities. Obviously, they don't. Because if they were as smart as they think they are, they wouldn't put themselves in debt to sit in those classes. It isn't worth it. And again, I just, my world view, my experience is, fortunately, I didn't put myself into debt, but I spent 20 some odd years, 25 years, teaching surgeons how to work with surgical instruments, the most advanced surgical instruments of the day, kids, and I never even had a biology class. How the hell did that happen? How that happened was I spoke to some companies and said, I don't have that, but I can learn, and I'm smart, and I'm this, and I'm that, and if you teach me, I will return that value to you. And they gave me a shot, and I did. They made money, I made money. But it wasn't from the goddamn colleges, really. It was more from the nuns in grammar school that taught us how to speak, how to write, cursive, by the way, cursive. Taught us how to read, how to understand, how to memorize, and how to work, because we had to work. We had homework, and we had to compete. In grammar school, we competed at everything. Spelling bees, math bees, reading bees, up in front of the class, day after day after day, for the first 8 years of my life. I should have stayed all the way through. I didn't. Then when I went to public school, I'm like, what a joke. I never had another homework assignment because I had it all done before I left. But not in that parochial school. They were really, really good. And but it wasn't so much the specific book knowledge as it was application. And we do the same thing here, even from a trading standpoint. And you can learn this. You've just got to put yourself into a silo, and you've got to apply all of the things that you've learned, and then just apply it and execute it, and don't worry about everyone else, or the world or anything else. So you just gotta get in and do what you gotta do. And if everyone, I tend to think that if everyone did that, we'd be in a lot better place, right? But anyways, we won't digress. Glad you enjoyed the video. 15 years ago, imagine that. 15. How's the image, Thomas? Thomas, DT. Is it your image on YouTube pretty good? Little clearer, maybe. I hope. Have to let me know. Scale 1 to 10. We still up around a 7 or 8? I'll take a 7 or 8 if it is. If it isn't, you let us know. Now, if you had, this is the thing, if you had $1 million in 1980, geez, 1980, I wonder what gold, I don't know, at most gold, I would have to go back to a chart. At most, it would have been trading at 300 at most. Probably was trading at 200 or something. So if you had a million, or your grandfather had a million, and he got himself out of, and he didn't have Bitcoin, right? But he got himself away from dollars. If he bought real estate, he would have been all right. If he bought into a business that was profitable, and he would have done very well, right? Or gone with Buffett, and got into multiple businesses, you would have done extremely well. Um, but if you had put $1 million into gold, at 300, you would be up, what, tenfold. So you wouldn't have a million, you'd have 10 million, not bad. But if you just bought, if you just sat on cash, then, and you didn't even get a return, you just get a cash, you just got $1 million. Now you might say, oh, that's a million, but that million would have bought a hell of a lot more in 1980 when cars were, $1,500 and an expensive home was 30 grand or whatever it was. Maybe more than that, average home, right? So that's, classic case of how inflation is the thief in the middle of the night and how they do it. And they steal. Teach your kids. Get that money converted into a hard asset. So if he holds the line, the dollar should rally. If he holds the line, he doesn't cut at all, and the market won't like that. And gold will come back. That'd be the guess. But if he cuts, and if he cuts hard, if he ever cut 50 basis points, well then market loves that liquidity. So we'll see. We're gonna stand back. And you don't have to trade in this, right? And there's not a rush. Don't think you have to be minutes, in front or anything of this kind. Just kind of watch. Swing Machine is going to be trying to get the trend, and it could be violent up and down. So if you're skilled and have tools for point and figure, that could be a better approach in the violence that is, that can occur with, up and down, fast up and down action. Right now, the 5 minute looking at 155, the ES is down. The 5 minute on the VIX is trying to go long, so it's getting a little 145. Are these going to hold through to the afternoon? They might. The Dow is trying to get short now. The Russell at 155. We'll see if they hold. So it looks like no change. All right, let's go get a peek at the interest rates. Let's see what's going on here. Let's go get a gander. Um, let's go to the yield curve. So this is what's going on. If they didn't cut, it doesn't look like they did. So this is going to hold here, and then these are going to go down. And that's what they're doing. So now what that does, it's going to exacerbate the yield curve. It's going to, in my view, um, it's going to uh, may throw the economy over the cliff eventually here, and that's what I think will happen. Is I think these rates will go down, and these are going to hold steady, and they may even go. They're not moving at all here. They may have been frozen, but they get to 4.5, get above 4.5. They ever start going to 5, put a fork in it. You know, these markets will be, and the economy will be in a recession, maybe worse, and people will be selling stock not because they want to, but because they have to. But we'll see. I don't want to add to it because it's intraday, and it is what it is. So let's just get a snapshot of what Swing Machine is doing here. The VIX at 2 o'clock is confirming long. The ES goes short at 155, and it's still on. No reason to come out now. 145, 2 o'clock, 155. Now this is interesting. Gold. Now see, this is the issue with gold. I would think I don't have the dollar up here. I would think the dollar is going to rally a little bit, but gold is being used as a place to hide. To try to hide, and so it's going up in the face of higher interest rates. So this could set up. I mean, if this continues, and the market does a crater, and maybe this Fed is just playing along. But like I say, Trump will blame the Fed, and he'll be happy for that. He's not gonna take the blame on it. I don't think it's well, but he contributed even in his first term. He was a big money print guy too. So they all are. Now we have another tool that is a daily signal. A daily signal. It doesn't change every day. It's not out to try to nail the next day per se, but it looks at the underlying data of all four indices. It looks at the yield on 10-year Treasury, and it looks at the VIX. And it's a mathematical algo. And last night, to my surprise, nothing on a chart to be seen. It's not moving averages. It isn't. Um, Last night she went short. So I always kind of want to see it do well, but it did. It did, and we'll see. We'll see if it holds here. Now, sometimes the first move it can turn out to be wrong, right? So they could come roaring back. I don't know if he's holding a press conference and he's gonna say all kinds of Federal Reserve speak, Fed speak, bullshit, crap, data dependent, yada, 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 like he knows what the hell he's talking about. He doesn't know shit. I mean, this is, it's absurd to think that you can manage or guide, you know, multi-trillion dollar markets and economy. And you talk about hubris, but that's what they're out to, have people believe. I don't buy it. What I do know is that if you're short, you're making money. I want everyone to know you can sign up for free at the CME site. They have some education there. It's free. I suggest you do it. It's a very nice site. If you do sign up for free, they're going to run a contest. You got to use their trading platform. Um, so we can't automate it, but we can use our tools. And it's going to run from the first week of June for an entire week, from Sunday night to Friday at 1 o'clock. And you can compete. And now it's on their platform. It's simulated, but it can't be rigged. The only thing I don't like about it is it does encourage excessive use of margin because they only give prize money to the top three people, and there'll be a few thousand people. And we are entered. We will play. I'll keep you posted on it, and we are out to win that thing. Right? We've done it now 3 or 4 times. Um, we've had two of the three. We've done it 3 times. 2 of the 3 we were inside number 10 going into the last day. One of them we ended up finishing 20 out of like 1,500. The next one was like 2,000, and we finished number 7 outside the money, but number 7 out of 2,000, entities, people, teams, college kids, whatever. I don't know. It's and other traders. And then the other one, we weren't in the top 10, so we didn't push real hard, and we finished, I think, number 50 or something out of like 3,000 or so. So we will try it, but we are out to try to win it. I do want the bragging rights. I want to win the thing, and so we will give it our best. And you could too, you know. So just an FYI. Okay, so this also presents. I don't want to, don't let me cloud the picture on the Fed, right? I mean, we talked about it, whatever. So you got a perspective, and you know, you can read the books and digest it. It doesn't matter. Don't let it distract you from our lives, our trading life, our lives, right? It exists for everybody. They all got to deal with it. We're in a much better position than they are. Um, I want to change the the VIX to an hour. Let's just take a look at this for a minute. 60 minute. When did it go long? 42 hours ago at 9 p.m. 42 hours ago. That was 2 days ago. Did you catch that move? 42 hours ago. Now, I haven't seen this, but I'm willing to bet. Watch. We're going to put this on a 60 minute. Okay, I would have thought maybe it was 42. It was 6 hours ago. It was at 10 this morning. 10. How about the NQ? Let's see when that one went off. 6. 10 a.m. How about this one? Now, why is the Dow up, right? Well, the Dow is just 30 stocks, so don't give it any. It's trying to get short. Now, the reason why the Dow always lags, it's only 30 stocks, but some of these mutual funds and so forth, they have to be invested. They can't go to cash. They have to be invested, and so they will go. They will go to the Dow 30 as a safe haven. They're not looking to get a return on their money. They're looking to get a return of their money. So they'll plow into Walmart and J&J and shit like that. Now the other tell is the Russell though, the small caps. When did this one go off? 5 hours ago. Okay, I was thinking that was maybe would have been like 30 or 40 hours ago, but maybe not. All right, so that's where we be. All right, I'll put it back. Don't let me. Oops, how did that get to a 5 minute? That was supposed to be one. I didn't mean to mess that up. Let me put this back to a 5 minute, and we'll let you watch. Oops. Uh-oh. I better be careful here. We don't overdo it. We're getting a lot of volume coming through. We got a lot of tick charts up, so I don't want anything to lock up. Now, if he's holding a press conference, he's going to get, Steve Wiseman, you know, oh, Mr. Chairman, what do you think about this? Well, and then and there very well could be, he says something that is scripted, and then suddenly Citadel, acting on behalf of, the banks, comes plowing in, and then, they'll be like, hey, that's, the Fed said this and the market did that, as though they have it on a string. Maybe for a few hours, maybe for an afternoon they do, but you know, but not forever and ever. It's been a long time though. It's been, I mean, we've had basically a bull run, for 15 years. We had a pullback, the COVID pullback, but we were technically pulling back. That's when interest rates really started to first rise, right? That was in front of COVID. I personally think COVID was just an excuse. Okay, Fib is telling us there's an FOMC press conference at 2:30. All right, 2:30. So they're gonna, yeah, yeah. He's gonna have to, and he's probably, why didn't he start right at 2? Then okay, yes, the market's doing this. So be ready. We'll see. We'll get a front row seat. We'll see. In order for the fives to turn around, the 1 minute's gonna have to turn around too. Thanks, Fib. Like I say, Susie won't even trade on Fed Day. She hates the Fed, like me. We all do, and so she don't even want to be bothered. Like, I just don't need to be bothered. And On a position basis, we are short the market, on a position basis. So we'll see. Yeah, no problem. Now, I bet you Fibonacci can tell us from the high of the S&P to the low, which was what, about 6,200, 6,150, to the near term low, which was what, around 4,800 or so, 4,900. We have retraced how much of that? I bet you it's probably around 618, right? Right around there. We retraced it, which means we're at the inflection point, and we would expect that thing on a daily basis, or on that map, that price, that we would be headed right back down the other side to go back down and plumb out those lows, take those lows out. And then we could do a price extension. And in round numbers, that would take us down to about 60, if we say 6,200, 1,200. It take us down to about 3,800, thereabouts. Somewhere's 38, 3,900. Now, that could be in the fall. That could be. It's not going to be all in one day. Lots of trading in between, though. Okay, folks, and they're going to get the Fed out of here in one piece. We'll see where they want to close it tomorrow in the week. Not terribly surprising. At 4 o'clock, we'll need to end the broadcast, folks. Thanks for stopping by. Okay, folks, we got to wrap it up. Not much of anything, right? We'll see. We'll see where they want to close it tomorrow and where we want to close it at the end of the week. It was kind of a eh, not much of a Fed day, and par for the course. Hope you guys are doing fine, and hope you're having a good week. And